previous chapters, we talked about budgets and comparing actual to what we had budgeted for and looking at those differences. In this chapter, we're going to look at these variances and break them down even further so we can see where these differences are coming from. Companies can use a standard cost system to record their product cost. What happens is they set standard costs for direct materials, direct labor, and factory overhead. These standards are set by the accountants, engineers, managers that work with these three sets of costs and come up with a standard. A standard is something that the cost should incur. We have two different types of standards. We have ideal standards. This is meaning that everything is going exactly as planned. No one is taking an extra long break. All of the materials are high quality and nothing is broken or lost. Things like that. Ideal standards don't typically happen. So what we look to achieve is currently obtainable standards. Currently obtainable standards, often called normal standards or practical standards, are standards that are used by most companies, and what this does is it takes into consideration those normal production difficulties or mistakes. This is a reasonable standard and used to set what should these costs entail. So what happens is companies record everything at their standard costs, what everything should cost them to make, and then we record these variances. A favorable cost variance occurs when the actual cost is less than your standard cost. An unfavorable cost variance occurs when the actual cost exceeds those standards. So it's favorable if you're paying less than you should have paid. It's unfavorable when you've paid more than you should have paid. We will look at the manufacturing cost variances. That's what these budget performance reports are going to show us. But total manufacturing cost variance is the difference between total standard cost and total actual cost for the units produced, as we did on that budget performance report. But for control purposes, we want to see each product's variances separated into two different distinct categories. We want to look at the direct material cost variance and the direct labor cost variance. We'll also, in the future, look at those overhead variances as well. But first, let's focus on these direct material and direct labor variances. For each of them, you're going to take your actual and subtract your standard. For direct materials, you take your actual price times your actual quantity and subtract that standard price times your standard quantity. For your direct labor, we're looking at actual rate. That's your actual rate paid to your employers times the actual hours used. And you're going to subtract your standard rate times your standard hours to get that total labor cost variance. This total manufacturing cost variance is broken down into our three product cost variances. We've already taken a look at that direct materials cost variance, but what we're going to do is break that apart even further so we can see exactly where these variances are coming from. That direct material cost variance is broken into two pieces. Our direct materials price variance, or looking at what was the difference in price between our standard price, what we thought we should pay to purchase these materials, and our actual price, what we thought what we actually had to pay. We'll also look at the direct material quantity variance. How much materials did we actually use versus how much should we have used in making the product? And those two pieces come to our total direct materials cost variance. Then we move on to our direct labor cost variance. This again is broken down into two pieces. We'll look at our direct labor rate variance, or how much we paid our employees compared to how much we should have paid our employees. and our direct labor time variance. The time variance is referring to hours used. So we'll take a look at the actual hours used versus how many hours should have been used to produce these products. And then we'll take a closer look at our factory overhead variances. The first factory overhead variance refers to the variable factory overhead controllable variance. And the second one is looking at the factory overhead volume variance. This refers to that fixed overhead. First, let's take a look at the direct material variance. If you recall, the actual price times actual quantity minus the standard price times standard quantity gives you that total direct material cost variance. But in order to break that down further, we want to look at our direct material price variance and our direct material quantity variance, which makes up this total material cost variance. So if we take our actual price minus our standard price, and we'll multiply that by our actual quantity, we would get our material price variance. This is on the left side of this chart. Then we'll look at our material quantity variance. The material quantity variance is looking at the differences in quantity. Therefore, we take our actual quantity minus our standard quantity, and we'll multiply that by our standard price. This will give us our material quantity variance. These two combined, our material price variance and our material quantity variance, will give us our total material cost variance. Let's take a look at an example of our material cost variance. In this example, our total cost variance is $2,650. We get our material cost variance by taking the actual cost and subtracting our standard cost. But what we want to do is really break this down further to see where this variance is coming from. To do that, we'll break it down into our material price variance and our material quantity variance. For material price variance, we're looking at the difference in price, and we're going to multiply that by our actual quantity. We know that this is an unfavorable variance because our actual price paid exceeds our standard price. We paid more than we thought we should have to. Then we'll look at our material quantity variance. Our material quantity variance compares our quantity and multiplies that by standard price. Here, we know we have a favorable variance because we used less quantity than we thought we were going to have to. So that's a favorable variance. When we combine our material price variance of $3,650 unfavorable with our material quantity variance of $1,000 favorable, we would get our total direct materials cost variance, which is $2,650 unfavorable. Next, let's look at our direct labor variance. Again, that total labor variance is going to be the difference between our total actual cost minus our total standard cost. But in order to break that down further, we're going to look at our direct labor rate variance and our direct labor time variance. This is what these two things combined make up our total labor variance. To get to our labor rate variance, you're going to compare your rates, which is your actual rate minus your standard rate, and multiply that by your actual hours. This gives you your labor rate variance. Again, if your actual rate exceeds your standard rate, you would have an unfavorable variance. The labor time variance looks at how efficient our employees are using their time. So we're comparing our hours. You compare actual hours minus our standard hours, and we'll multiply that by our standard rate. This again, if your actual hours exceed your standard hours, you would have an unfavorable variance. Whereas if your actual hours are less than your standard hours, you would have a favorable variance. And these two variances, your labor rate variance and your labor time variance, combined make up that total labor cost variance. Here's an example of our labor cost variances. Our actual cost minus our standard cost gives us that total labor cost variance, which is $2,500. What we want to do again is break that apart even further so we can see where this variance is coming from. We'll do that by using our equations for labor rate variance and labor time variance. Labor rate variance looks at our actual rate minus our standard rate and multiplies that by our actual hours. We know that this variance is unfavorable because our actual rate exceeds our standard rate. Then we look at our labor time variance. We look at our actual hours versus our standard hours and multiply that by our standard rate. We know that this is a favorable variance because our actual hours are less than our standard hours. When you combine these two, you get to that total labor cost variance. Finally, let's review our overhead variances. First, we'll look at our variable factory overhead controllable variance. In order to get this variance, we take our actual variable overhead and we subtract our budgeted variable overhead. Our actual variable overhead can be determined by taking our total overhead and subtracting our fixed overhead. This is all actual amounts. If it's not given to you, they typically will give you that total overhead and your fixed overhead. To get to the budgeted variable overhead, we have to use our standard hours for actual units produced. So how many hours should it have taken to produce the actual number of units we did? And we're going to multiply that by our variable factory overhead rate. In order to get that variable factory overhead rate, we take our budgeted variable overhead and we divide that by our budgeted variable hours. Then we'll look at our fixed factory overhead volume variance. The volume variance is looking at the number of hours we use at 100% capacity versus how many hours we actually used. So we'll take our standard hours for 100% normal capacity, subtract that from our standard hours for the actual number of units produced, and multiply that by our fixed overhead rate. To get to that fixed overhead rate, we'll take our budgeted fixed overhead and divide that by our standard hours at 100% capacity. We'll take a look at an example of this to walk you through it a little bit further. First, let's look at this variable overhead controllable variance. In order to get that variance, we need to look at the actual variable overhead and compare it to our standard variable overhead. Our actual variable overhead is given to us. We have to calculate what our budgeted variable overhead should be. The first step in this is to calculate our variable overhead rate. To get our variable overhead rate, we take our budgeted variable overhead and we're going to divide that by our budgeted variable hours. So in this example, it's going to be $3.60. We'll take that $3.60 and multiply that by our standard hours at actual units produced, or how long it should have taken to produce the actual units that we did produce. We multiply that times our overhead rate to get our budgeted variable overhead. We can then compare that to our actual overhead, and in this situation we would have a $4,000 favorable variance because our actual overhead is less than our budgeted variable overhead. For our fixed factory overhead volume variance, we're comparing our standard hours at 100% normal capacity to the standard hours for actual units produced. Your standard hours at 100% capacity may not equal your variable budgeted hours. In this example, they just happen to. But our standard hours for actual units produced will be the same. So again, our first step is to figure out what that fixed overhead rate is going to be. To get that, we'll take our budgeted divided by our budgeted. So our budgeted fixed overhead divided by our 100% capacity hours. That will give us our overhead rate for fixed overhead. In this case, it's $2.40. So we're going to take those difference in hours and multiply it by $2.40. We have an unfavorable variance because anything that is under 100% capacity will be unfavorable. So it's very likely that your fixed overhead volume variance is going to be unfavorable. A report that summarizes these actual costs, standard costs, and the differences or variances for the units produced is called this budget performance report. So it's based on actual production rather than that planned production. So if you think back to those flexible budgets, that's what this represents. Actual costs, standard costs at actual number of units, and then those variances. And we look to see whether those variances are favorable or unfavorable. A balanced scorecard is another way to assess performance and anticipate results. It provides measurable objectives for non-financial measures. For example, we look at internal processes, consumers, learning and growth, other than just the financial piece of it.